So a lot of people know what superannuation is, but they don't know how it affects our tax returns and affects our tax and the income tax that we pay. There are multiple ways of putting money into superannuation. So yes, there is that employer obligation and your employer putting money into super, but there's also another way where you can voluntarily contribute money into superannuation. Normally, in this case here, you can actually get a tax deduction in your personal tax return. And that gets limited up to $25,000 a year. That sometimes changes every year, but currently in 2019 to 20 financial year, it's actually $25,000. So the benefit of putting money into a super fund is that when you do decide to retire and when you reach the preservation age currently sits at 55 to 60, and it depends on when you were born. So best to go online to work out which preservation age works for you. But basically, once you reach the preservation age and decide to retire, you can actually withdraw money out of the super fund, and that money that you receive is completely tax-free. And on top of that, money that goes into a super fund that you've been contributing is reinvested by these funds, and it does actually receive income when it invests its money. So it could be making 3%, 5%, 8% in return every year, and that money will be tax-free once you reach the preservation age. But how does superannuation affect your tax? So superannuation affects your tax because when you contribute money into the super fund, the money you contribute into the super fund, it's deducted out of your taxable income at the end of the day. So that means that basically, if you earn $100,000 in your personal name and you decided that you wanted to contribute some money into the super fund and you decided to contribute $10,000, that $10,000 you contribute gets taken out of your taxable income. So therefore, you would have earned only $90,000 in your taxable income. So the tax rate on $100,000 would have been 37%. And by reducing your taxable income by $10,000 because you're contributing into your super fund, you would have saved 37% of that $10,000, which is $3,700 you would have paid in your personal name. So that contribution will go straight to the super fund, and that $10,000 will show up in the super fund balance. And that super fund now will have a $10,000 income and get taxed at 15% because super funds are getting taxed at 15%. So essentially, you would have paid $3,700 in your personal name, but you've moved these funds into the super fund, so you don't need to pay the tax in your personal name anymore. But in the super fund, you pay $1,500, which represents the 15% tax rate that you had to pay in the super fund. So as a result, you save $2,200 in overall tax between the two entities, so the super fund and your personal name. So there is a good savings by doing this, but you cannot access your super fund balance until you reach preservation age, and you would have had to retire as well. So if you're a high income earner, you could also get an additional 15% tax. So if you earn over $250,000 in total, including your superannuation and your total earnings for the year, you may be hit by Division 293. Basically means that you would get taxed an additional 15% in your superannuation fund because of your high income that you've earned. So if you actually think that you're going to be earning over $250,000 for the financial year, it will be a good idea to speak to your accountant so you can maybe do some sort of tax planning to either reduce your total taxable income for the financial year or do something about it. Overall, despite your age, you should really still think about your superannuation. I know when I was young, I actually didn't think about superannuation at all. And I actually really regret not doing that in the first place. So speak to an accountant or a financial planner to work out the best course of action for you.